Good morning. I'm Neil Barclay, Chief Executive of Meridian Energy, and I have with me Mike Roan, our CFO. And welcome to Meridian's annual results presentation for the year ended June 2019. In short, the annual results have been extraordinary. There have been several significant factors outside of our control that have contributed strongly to Meridian's share price appreciation and our total shareholder return of 59%. Wholesale market prices have also worked in our favour, supporting EBITDAF growth of 26%. However, I do believe the result is underpinned by very strong execution and progress against our strategy. And these things are within our control. I'll talk to most of these key highlights as we go through this presentation. But in summary, we reported double-digit Australasian customer growth, which reflects our leadership in sustainability, the strength of our brands and the quality of our customer care. We produced record New Zealand hydro generation off only slightly above average inflows. With the Oho A refurbishment in full swing, we relied on strong portfolio execution to capture high wholesale prices throughout the year. Now, people are key to our success. We intend to continue to build our more diverse, more inclusive and more engaged workforce. Our gender balance, pay parity, diversity and inclusion measures all continue to move in the right direction. Shifting the dial on these does take time and perseverance, and the board and management are fully committed to continue to drive for positive change. Now, there is a lot of change going on at the executive team level, but that, I think, creates opportunities and chances for renewal and new thinking. Jackie Cleland, Paul Chambers, Julian Smith, Egg McManus and Ari Sargent have all made personal decisions to move on to their next career steps. We've introduced Tanya Palmer, Nick Kennedy from outside the company. Mike has obviously changed roles, and on Friday we announced Chris Avers is stepping into the GM wholesale role. We're progressing with further new appointments for our Chief Customer Officer and Australian CEO, and we're looking at both internal and external candidates for both of those roles. The makeup of Meridian's board is also changing, with several directors, including the Chairman Chris Moller, retiring. Mark the Beast will chair the board from October, and we recently announced 3 new women directors. Now, certainly the most sobering aspect of our performance in the last year has been in relation to safety. Our lost time injury rate spiked in FY19, and 2 of those resulted in serious hand injuries. Now, while I remain confident that our safety culture and processes are strong, we can't take that for granted. So we've sought specialist external advice to help us ensure our work site environments and the safety behaviour of our people remain at the highest levels. Meridian's strategy is relatively simple, and whilst our approach to delivering against that strategy is always evolving, the strategy itself has been a constant for some time. The slides that follow provide context and performance against these strategic initiatives. Sustainability. It's a broad church, and so we focus on areas that we can make a real difference. We remain committed to the 2 key sustainable goals relating to climate action and affordable clean energy. We are determined to walk the talk and remain committed to only generating electricity from wind, water and sun, and we made good progress in several areas during the last year. We're supporting our customers with clearer, fairer pricing and more payment support options. I think the position we took on PPD is a good example of this. The Meridian Group became net zero carbon, and we've also adopted a target to halve our gross emissions by 2030. And we recently became the first New Zealand company to disclose the risks climate change posed to our business. While headline demand growth for the year was modestly positive, a relatively low irrigation season masked what we believe is more substantial underlying growth. Consequently, Meridian and others are making noises about new builds. In the medium to long term, there are a range of views on demand growth and energy efficiency opportunities, but if New Zealand is to get anywhere near its goal of zero carbon by 2050, then a significant uplift in new renewable electricity is required. Even partial decarbonisation from known technology sources suggests at least a 50% increase in current demand over the next 30 years. We will need more positive consenting framework and a population that supports wind farms, even in their backyard. But I think providing future governments remain committed broadly to the well-functioning open market structures we have today, then investors in generation and storage capacity will have the right incentives to efficiently meet that demand. The short-term supply position was dominated by the gas system issues that I'm sure you're all familiar with. Hydro inflows were not particularly unusual, but the two significant dry periods during spring and autumn did coincide with both Porakora outages. The longer-term supply outlook is interesting. The timing of the end-of-life profile shown here won't be exact, but it does highlight that within the next 20 years, around 30% of New Zealand's current generation capacity will either face replacement or repowering investment decisions. This, coupled with the potential demand pull from decarbonisation that I talked to on the previous slide, suggests the industry sits on the verge of a significant investment cycle, albeit with some uncertainty around timing. We remain hopeful that the interdecadal process to reform transmission pricing will be implemented. The EA published their latest discussion document in July. The EA proposal is to replace the current regime with a benefit-based charge and a residual charge. Now, most importantly, this means that the HVDC charges currently levied on South Island generators as a form of tax will be abolished. Meridian is the largest South Island generator, wears the bulk of these costs today. Implementation could be as far away as 2024, but the good news is Transpower's RCP3 process will deliver a significant portion of the savings to Meridian commencing in April of next year. On the electricity pricing review, we have publicly been very clear that Meridian is supportive of the draft suite of initiatives put forward by the review panel as a package. We await the government response on the panel's final report, which we understand is expected now sometime in September. Now, in my view, the big ticket policy regulatory reform in New Zealand relates to climate change. New Zealand has a unique opportunity to transform our economy, and renewable electricity is the solution to much of the country's emissions. In May 2019, the government introduced the Climate Change Response Zero Carbon Amendment Bill. Once passed, it is intended that the bill will set greenhouse gas and methane emissions reduction targets and a series of emissions budgets to act as stepping stones towards this long-term target. It establishes a new independent climate change commission to provide expert advice and monitoring to help keep successive governments on track. The Interim Climate Change Committee report was released in July and brought a dose of pragmatism to the goal of 100% electricity grid. More importantly, the report recommends that the government should provide for the development of wind generation at scale through strong direction under the Resource Management Act, and ensure the value of existing hydro generation to New Zealand's climate change objectives is given enough weight when decisions about fresh water are made. Clearly, we at Meridian are strong supporters of the bill, the ICCC report and ETS reform. Now, I'm delighted with how our New Zealand retail brands are performing. When we normalise for variable irrigation demand, the growth in customer numbers and sales volumes in all of our segments was strong. Price dynamics have been interesting. The competitive acquisition pressures in residential and small business have seen average prices fall, while the higher wholesale prices observed in the ASX futures market have flowed into corporate, industrial and spot exposed pricing. I'd also call out our growing commercial solar book. We have completed significant new solar builds with both Kiwi Property and Mainfreight during the last year, and the pipeline for new developments is expanding rapidly. Beyond the volume and price, the underlying drivers of retail value are trending well. Powershop leads the industry and Meridian leads the large retailers in Net Promoter Scores. Both brands were recognised as finalists as Retailer of the Year at the Deloitte Energy Awards last Thursday evening, and Powershop took it out. We're quite proud of that. Customer retention rates are improving and our cost to serve on a per customer base have declined by 6%. Progress on our Meridian customer migration to the Flux platform is slightly slower than expected, but costs remain under control and risks, if anything, are diminishing. The team have invested time upfront developing what we describe as our migration engine, and the number of customers unlocked for migration is building nicely. We have 22,000 customers migrated today, and I'm expecting we will hit 50,000 by December. What we've learnt through this process is the high level of variability in our current offers has created a legacy system and data set that is truly unwieldy. and a traditional Big Bang mass migration sometime next year, which would have been the way I've seen most of these projects approach this challenge in the past, would invariably have created massive customer disruption, as most customer migration projects do. By adopting a more iterative, agile approach, we're making sure the customer experience is seamless, and we're also adapting our core operations to operate in an agile way, even though we don't call it that. I'm particularly proud of the performance of our wholesale and generation teams this year. Sure, wholesale prices spiked significantly, but in the context of fairly average hydro inflows and some significant planned plant outages, the teams delivered a record amount of generation to take advantage of the high wholesale prices. Looking forward, our work on the refurbishment of the Oahu assets will cost us more than we originally planned, but that additional spend allows us to defer to significantly more spend in relation to the generator refurbishments by close to a decade. And while we look forward to better wind farm availability in 2020, we must navigate a significant HVDC outage in the first quarter of next year. The grid owner is undertaking a 3-month HVDC reconductoring project between January and April next year. Excuse me, effectively reducing HVDC capacity by a third to a half. And that presents challenges for us as we manage constrained generation where we have historically seen lakes spill 45% of the time. Now, none of this is insurmountable, and we're building our hedge position accordingly. But it's also fair to say that FY20 will likely be more operationally challenging than this last year. Firming wholesale prices means several new renewable developments appear to be well in the money. We're working through our consent variations for our Hawke's Bay wind options, and we have gone to the market with an expression of interest for the civil and electrical components of that work. Longer term, our objective is to maintain our market share of the generation market. And whilst we have more than 2,500 gigawatt hours of development pipeline, a lot of that work is needed to get those options consented or reconsented. As I mentioned earlier, it seems likely that the RMA frameworks for renewable projects will become more balanced. Our Waitaki water consents must also be renewed by 2025. We may opt to progress this earlier, as again, the regulatory framework in support of that scheme is moving in a positive fashion. And just to come back to the near-term conditions, ASX curves currently look like they reflect ongoing tightness in the gas domestic market. Australia, it remains hard to get a lead on what any sort of enduring energy policy in Australia could look like. The coalition government does not have a renewable energy policy beyond 2020. That said, renewables continue to dominate new generation builds. Opt-in default market offers are now in place, and that seems to have had the effect of compressing retail prices into a tighter band. PowerShop, with its differentiated product offering, could do well in this environment, we believe. Wholesale market prices remain reasonably volatile. Black prices firmed during this last year, but the green LGC prices fell significantly, and it's hard to see them recovering. And several issues are hitting renewable developers, causing project delays that could positively impact calendar 20 and 21 prices. Now, set against this price volatility is the issue of an ageing Australian coal generation fleet, with more than 60% of existing capacity past the end of economic life in the next 20 years. So what we've concluded is a well-hedged, vertically integrated business model is essential to making money and not losing our shirt, and that's exactly the approach we're taking. As I explained last year, the addition of the Green State assets and 2 wind farm power purchase agreements have allowed us to reduce retail hedge costs and renew our efforts to profitably grow the PowerShop customer base. The headline success story has been a 36% lift in customer accounts during the year. We've also significantly improved intention rates, developed higher brand awareness, and we have an NPS that's miles ahead of the industry average. We've expanded electricity in South Australia, and we will launch our second white label offer under the Kogan Energy brand next month. Now, Kogan has around 1.6 million active customers, and whilst I don't expect they'll all sign up to Kogan Energy, it does give you a sense of the size of their online presence. The story of note for our generation portfolio remains the New South Wales drought. Hydro volumes were significantly down on the last 5 years of historical performance. and that is why diversification is key. Mount Miller availability could be an issue for the next year or two, as the age of the wind farm suggests we are likely to see an increase in major component failures, but I don't expect this will be material. And overall, while we generated less than we hoped, we also cleared better average prices than last year, and the improved portfolio flexibility meant we landed significant gains during the high price events in Victoria during January. All up, our Australian business achieved our planned earnings growth for the year. And finally from me, PowerShop UK across all brands, PowerShop, Wigan, Wasps, npower, Select and most recently Sainsbury's, grew 50,000 customers during FY19 from 25 to 75,000. Now this is behind expectations, but it's fair to say the market conditions in the UK were very challenging, leading into the introduction of retail price caps. But this is a very low-cost growth option for us, and Flux continues to explore new opportunities in both the UK and Europe. So I'll now hand over to Mike, and he'll go through this year's financial performance in a bit more detail.
Thanks, Neil. As the result demonstrates, we had a cracker last year, lift in EBITDAF of 26, an NPAT of 26 and 69% respectively. From what were record numbers already in fin year 18 is superb by anyone's calculations. However, and as always, many of the variables that drove those outcomes were outside of our control, and the result does mask a few things that we have to work on. I'll explain some of these in the next few slides, but before I do, I wanted to reinforce something that Neil had mentioned, which is the incredibly pleasing thing about fin year 19 was the elements within our control were executed very well by our operating teams. So what does the result mean for our shareholders? Today we're announcing a final ordinary dividend of 10.72 cents a share and a final special dividend of 2.44 cents per share as a result of the capital management program. This lifts the full year ordinary dividend to 16.42 cents, the special dividend to 4.88 cents, and the total dividend to 21.3 cents per share. This total payment is 11% up on fin year 18 and reflects the outstanding year that we've just had. The dividend also represents a payment of 75% of free cash flows after considering stay-in-business CapEx. We settled on this level of dividend after considering the sustainability of its level in fin year 20 and beyond, and the opportunities we increasingly see ahead of us to redeploy cash within our business. In an environment where interest rates feel like they're likely to stay low, these opportunities, should they play out, exceed shareholders' value creation benchmarks in our view. Of course, we also need to manage our balance sheet through and beyond the remainder of the capital management program. As you know, our result was really powered by buoyant wholesale electricity markets in New Zealand, with energy margin here lifting by 164 million or 17% over financial year 18. It was superb. So what worked in our favour? Well, first off, our financial book, which are buy-side hedges, insurance products and derivative sales, provided flexibility to manage our way through the various challenges while adding 74 million to energy margin. Second, our wholesale and retail teams worked incredibly well to target high-value opportunities within the C&I market, and you would have seen the lift in C&I volumes and prices earlier in this presentation, up 8 and 7% respectively on fin year 18 as part of the result. We haven't seen average C&I prices at this level for a number of years, and in saying this, we realise there are real Kiwi businesses paying more for their energy as a result of the increase in underlying gas price. So we're working with them on energy efficiency measures where we can to help offset their increases. At the same time, our PowerShop New Zealand and Meridian customer teams lifted ICP levels by 11,000. We know how competitive and challenging retail markets are, so we put most of this growth down to building service and product offerings that can be realised by the Meridian Energy Centre in Christchurch, the PowerShop call centre in Masterton, or through the Flux product set directly. Now, there are always a few things you wish you could do again, and we probably held on to acquisition rates for longer than was useful in the early part of the year, which ultimately weighed on our average residential price. But as we all know, you don't get to do things again in life, so you have to learn from them, and we've done just that as we enter fin year 20. As for the things outside our control, inflows were a little late in coming last year. They didn't really get going until March. But we had adequate storage in the first half of the year, and were really able to capture opportunities in the second where they did arrive. And while the gas market upheavals were entirely unexpected, the storage position and ongoing inflows helped the wholesale team deliver outstanding results with record production volumes and the resulting spot length sold into higher than expected spot prices. Interestingly, or not, inflows over the year were only 104% of average. But all up, our physical book added $91 million to energy margin. At the same time, we had a good year in Australia. In Australia, energy margin was $32 million higher than the previous year, driven by a full year of Green State production, a reasonable lift in sales to electricity and gas customers, and a well-executed derivative position. And while I'm on the topic of derivatives, I want to talk about LGCs quickly. These added $27 million to energy margin last year. Now, you might remember that LGCs trade on a calendar year basis, so each financial year represents a weighted blend of 2 calendar years. And we expect that FY 20 blended LGC price will be 30 to 40% lower than that seen in FY 19. However, we run a pretty conservative hedging program, and we have forward sold a substantial number of calendar year 19 LGCs, which will settle in February 2020 at prices significantly above this level. As a result, we expect our LGC revenue in FY 20 will be in the low $30 million range. So the Australian results were pleasing, but we'd have loved it to rain a little more over there. The lucky, or in this case unlucky country, is in the midst of a multi-year drought. And while we allowed for this when we purchased the Green State assets, the lack of rain meant generation from those assets was only around 85% of expected levels. And while the Southern Oscillation Index has recently returned to neutral, we haven't seen torrents of rain into the Hume, Keepit or Burrinjuck catchments as yet. In saying this, we think that the FY 20 production levels from those assets will only marginally be lower than FY 19 if the rain stays away. So moving on to costs. Total costs lift by $23 million over FY 18, driven by a growing business and refurbishment of the Oho chain that will continue through the next 3 years. And that increase can be broken down further into $4 million in additional customer servicing costs in New Zealand, a $7 million lift in spend in our New Zealand asset business, and a $12 million lift in spend in Australia due to growing customer volumes and a year of Green State asset OPEX. Now I want to pause here for a sec. And the reason for this is that, as the slide suggests, we're forecasting OPEX for FY 20 for the first time as part of this presentation. As a management team, we should be able to tell you what we expect to spend, so that's what we're doing. For FY 20, we expect an OPEX profile of between $280 and $286 million. Now that is after adjusting for the change in treatment for operating leases, which flow from the adoption of IFRS 16 in FY 20. And it's a comparable lift on FY 19 of between $4 and $10 million, with the change being driven by expected ongoing growth in customer numbers in New Zealand and Australia, and the ongoing multi-year Oho refurbishment program. Of course, the combination of energy margin on one hand and costs on the other produce EBITDAF, and EBITDAF was $838 million. This was a lift of $172 million on FY 18, supported by New Zealand EBITDAF of $757 million and Australian EBITDAF of $64 million. Flux, while materially servicing the Meridian Group, did extend its business in the UK and provided the remainder. For the accountants among us, NPAT also increased by 69% to $339 million. The reason for this was simple. Cash delivered by the operating businesses grew faster than depreciation, and while Treasury hedges got smashed as the world's monetary policy masters facilitated a reduction in borrowing costs, the lift in fair value of electricity hedges didn't hurt a bit. Note, we did adopt IFRS 9 during the year to ensure our accounting of derivatives aligns with that standard, and in FY 20 we'll adopt IFRS 16 and eliminate the concept of operating leases. The effect of both are captured in the notes to the statements. The final elements I'll focus on in this slide are the group asset valuation lift of $1 billion, a small impairment to Mount Miller, and a lift in the Green State asset value. Hopefully the large valuation lift doesn't surprise, as the market's view of Meridian's value has lifted material over the year, but the small impairment to Mount Miller might. This is not the first impairment for Miller, and the reason for it is simple. you can now build wind farms in Australia for a levelised cost of energy below $60 a megawatt hour. And while Miller and Mercer's value are holding up as a result of a fall in cost of capital, Miller was purchased at a levelised cost of energy of approximately $85. So it's possible that they'll face valuation challenges as we move forward. However, the lift in Green State value from our purchase price of $168 million to $223 million affirms our decision to purchase these assets that support our aspirations in that jurisdiction, even in the midst of a drought. I won't take too much time on the capital slide, not because it is interesting, but because it's straightforward. And again, just like OPEX, for the first time we're forecasting CAPEX for the coming period. For FY 20, we're expecting CAPEX in the order of $70 to $80 million. That is made up of $50 to $55 million of stay-in-business CAPEX, a little above what we did last year, and investment CAPEX of between $20 and $25 million, reflecting work on a generation development pipeline and ongoing investment in the Flux platform. Which leaves us only with balance sheet funding. As you can see, funding is reasonably well diversified, both by tenor and by source, and net debt is lower than we expected this time last year. But as I alluded to earlier, we and many others wish we didn't hedge the majority of our interest rate exposures given the falls experienced in those markets over the past 9 or so months. That said, we're here to make electricity and returns for our shareholders, not trade our balance sheet. And all up, it was a superb year financially that'll be hard to beat by any stretch. Neil, back to you.
Okay, I'll just sum up by saying, whilst we're obviously pleased with the results for the year, as Mike was just alluding to, it would be unrealistic to expect the same kind of financial outcome for FY20. We won't issue earnings guidance, however, we have given you a sense of where we expect controllable costs for FY20 to land, and we are providing comprehensive monthly operating results. The tight gas market, upcoming field outages and the planned HVDC outage program are potentially significant events for the new financial year. In the meantime, our July operating results show that we have continued with our strong retail and generation performance. Most importantly, in the medium term, the potential for sustained growth in New Zealand looks very good. In Australia, positioning our Challenger brand as the country's only 100% electricity generator means our potential for growth remains significant there as well. And that's pretty well us. We can now take some questions, and I think we'll go to the floor first. I was just explaining we've got a microphone here that should do the business. If you could please state your name, who you represent before asking the question, that would be appreciated. Any questions?
Thanks, Neil and Mike. I'm Andrew Harvey-Green from Forsyth Bar, for those that don't recognise the voice. Couple of questions for me. First one, I guess, just around the dividend, and obviously we're at the very end of the payout ratio in FY19, and I confess I haven't actually done the maths, but assuming there is a bit of a drop in next year, would Meridian choose to stick with the 90% of the top out of the payout ratio, or would you actually look to drop the dividend if earnings were to fall that much?
Hey, Andrew, good question. We are unlikely to change our policy range, 75 to 90%, as part of the dividend policy as we look to FY 20 or beyond. We think it gives us flexibility, given the way our balance sheet's set up and the cash flows that we expect through the next 12 months.
Next question I just had was around OPEX, and I recognise there's a small lift on FY19, but if we actually go back to sort of FY18, we've got about a $30 million increase in FY20 versus FY18. Are you able to just give, I guess, a bit more colour, and I think you've done a reasonable amount, but maybe a little bit more colour just around the amount of one-offs versus sort of underlying growth in OPEX. It is a wee bit different, I guess, compared to what we've seen from some of the other gentailers who are sort of keeping that OPEX space reasonably flat.
Yep. Andrew, again, good question. So we have grown, we've got growing businesses, and both in New Zealand and Australia. And so you see, answer the first part of your question, there's no real one-off nature for the underlying increase in costs you experience in your retail business. They're related to customer growth. So we've seen that in both Australia and in New Zealand. think we talked about the OHO program and the lift in OPEX as a result of that, and we expect that to play out over the next 3 years. And then the other piece that I did mention specifically was the other element that we've added to our Australian business is a lift in OPEX as a result of full year of Green State assets. So, to the extent we have an ongoing growing business, we would expect costs to lift through the next year in the same way as I presented.
I'll just add that we're midway through our project momentum, which is moving the Meridian customers onto the Flux platform. We do expect to see some reasonable operating efficiencies come at the end of that program. So they'll start to flow through in calendar year 21. And also the OHOs start winding up around 22, 23, so you'll start to see some of that cost come out of the base as well.
So that's effectively where we should maybe start seeing costs come down a little bit.
Yeah.
Next question is just around the Hawke's Bay wind farm, and if you're able to give us, I guess, sort of timeline around decisions. And I think in the past you talked about potentially undertaking construction during the summer months of some of that civil work. Is that the current proposal, I guess, coming into the current summer, or? Yeah,
well, we're doing preparatory work, or we've done some preparatory work, plus we're looking at some aspects of the tender. We're working through a consent change right now. If that were to come through, then we could be in a position to have a go, no-go decision on that late this year, which would potentially leave us in a position where we could start work, serious work, sort of this summer, probably the other side of Christmas. We haven't made that decision, and that's a board level decision, but that's what we're aiming to give ourselves the option to do.
Okay. And last question for me was, able to give us a bit of an update, I guess, on progress around the swaption replacement. In the past you sort of talked about being very keen not to use coal going forward. I assume that's still the case? That's absolutely still the case. We've got a process that's live at the moment. We can't talk about it openly because it's it's a confidential process, but it's tracking well. Okay, if there's no more questions from the floor, we'll go to the phones. And again, please state who you are and what organisation you represent before firing into your questions.
Thank you, sir. For phone participants, if you would like to ask a question, please slowly press 0 followed by 1 on your telephone. That is 0 followed by 1 on your telephone. Your first question comes from the line of Grant Swanepoel from Craig's Investment Partners. Please go ahead.
Morning, Meridian team. First question, just on pricing, you did indicate that you would like to probably drop your discounts on acquisition earlier than you did. It would appear as though most of your competitors are trying to understand why this retail competition has continued. Do you think you've played quite a big role in keeping those prices down in this rising forward ASH hedge curve period? Question one. Question two, you mentioned that PowerShop transition of your IT system is going well, and we should expect by calendar 21. Are you still looking at 5 to 10 million of cost out from that in its full effect? Third question on HVDC. You mentioned that Q1 calendar year 20 is going to have quite a bit of an impact on that front. You've also got Puakura month outage. Why haven't you lobbied, or is that not possible to have the HVDC outage moved away from the Puakura outage? Then in terms of question 4 on growth projections, you guys are coming across slightly more bullish than the others, probably more realistic with the work you guys do behind the scenes. But in terms of your competitors, most of them are talking about building into holes that are developing. So Contact saying they will build in and take PCC out potentially. while you guys are still trying to hold on to your market share in terms of build, do you still see your first wind option as let's build that one and then let's wait and see how demand develops, or do you want to aggressively pursue your market share over time? Those are my questions. Thank you.
Okay.
Do you want me to take the first one?
You take the first one. And
Yep.
I'll
Hey, Grant,
take the
as
second
I
one.
heard the first one, it was pricing in residential markets and the role that we played. I don't think we're any bigger factor than anybody else in that space. It's a competitive market. There are something like 35 brands that are out there. We've been able to grow our presence in that space, I think, primarily as a result of the product and service offerings that are out there and our ability to get our teams and our energy centres out talking to customers. We obviously presenting ourselves a little differently than we have in the past through our brand, which has also had a positive impact on our performance. But no, my answer would simply be that those are competitive markets. Everybody's engaged in those markets, and from time to time, consumers do and should benefit from those levels of competition.
Yeah, I'll just add to that a lot of particularly the residential growth that we've had in the last year came through PowerShop. Now, PowerShop, as you may be aware, doesn't have a differentiated pricing proposition, so it's not the cheapest in the market by any stretch of the imagination, unless you take advantage of the sort of discount and shopper model that we make available. So no, I don't think we're the price leaders, or have probably been the price leaders through that period. Second question, cost out round Project Momentum, so that's our flux migration. Yes, we're still on track to deliver savings of that order. Now, just to put a bit more colour around that, Grant, the savings in terms of awarded capital plus operating savings. But when we look forward and model out the business, we think we'll take off about $10 million in cash costs per annum, sort of starting the back end of next calendar year. HVDC outages and Porakora and our ability to lobby. You can have a go at that one.
Yeah. So, yeah, look, Neil set out that there is a reasonably long but well-planned, it's been in planning for 4 years, outage of the HVDC link from January through April 2020. And we, like others in the market, have picked up that there's an outage of Porakora in March as well. It would always be nice if outages of that significance could be scheduled separately as opposed to on top of each other, but probably signals what we saw last year, that the gas industry and the electricity industry haven't got to the point where scheduling of key outages would support what we're trying to do generally. So there's some more work to do there. Getting outages of that magnitude changed, though, is very, very tricky. You're probably best talking to Transpower or the owners of Porakura to see what they might be able to do, Grant. We would love them to be able to shift them. We do note that Transpower has changed some of the outage profile for the bipole outages to try and cater for that. But it does make March a little trickier. As I said, the industry has had 4 years to plan for the HVDC outage, so it has been in Transpower's plan for some time. And while it will be tricky and things will be unexpected, we've been working on our position for a long time, recognising the impact it has on our business.
Yeah, and the short answer is yes, we do work very closely with the grid operator and point out where we think they could improve the outage program, but at the end of the day, we're just one interested party. And building our outlook in terms of the potential to build into holes, I guess the way we look at it, first of all, we look at our own portfolio position and what we project that to look like in the next few years. So we are giving ourselves the option to put more generation on the ground because we think we're going to have a retail load. We've already got one that's actually closing in on pushing our existing generation base. But we also know that we've got TCC sitting on the sidelines with spot gas primarily. So that's potentially not going to run that much. Also, these decisions, Grant, you've got to think about them in terms of whilst we might make a decision late this year, we won't have full production until probably 2022. So you're sort of looking at a reasonable time frame, and understanding and managing the risk over that time frame. But we did have on one of our slides too that there is a large amount of existing new generation that's going to have to be repowered or replaced in the next 20 or so years. So that will certainly be part of the build program that New Zealand is required to complete.
Yeah, and the only thing that I'd add is I think, Grant, is we've got great opportunities in New Zealand, but we're also looking to our opportunities in Australia, and we'll make sensible decisions as either the growth emerges in New Zealand or we grow our business into Australia. Our goal is to increase the returns we've got for shareholders, and having investment potential in both New Zealand, given the potential growth that's showing up as we decarbonise, but also with a growing business in Australia, gives us real opportunity to do exactly that, is invest in assets that are productive and useful.
Thanks, Grant.
Thanks for those answers. Great, thank you.
Thank you very much. Your next question comes from the line of Aaron Ibbotson from UBS. Please go ahead.
Hi there. Good morning, gentlemen. I basically had two questions. So first, just a clarification, and I appreciate that you won't give us a solid answer, but we have sort of got accustomed to ordinary dividends not being cut. So I was a little bit surprised by your answer, if I interpreted it correctly in the beginning, that you wouldn't deviate from your policy range of 75 to 90%. I sort of just struggle to understand the point of that and the point of then not using some of your balance sheet flexibility. If you're that tight, why not just skip the special now and be able to hold the ordinary in a poor hydro year? That was my first question. Secondly, just trying to understand if there has been any development, any conversations you want to share with us with regards to long-term planning of sort of dry winter risk when it comes to the Genesis swaption or discussions with the NZAS or anything else. Thank you.
Hey, thanks, Aaron. I'm always happy to talk about and get your views on our policy settings for dividend performance. I'm not sure if I caught the question as directly, but what we were trying to signal, Aaron, is that this year's dividend at 21.3 cents per share is something that we considered reflecting on the sustainability of that dividend for fin year 20. So, as we look at our performance next year and in the coming years, obviously we're exposed to variability around our inflows, and so we don't provide guidance, but we certainly have taken the sustainability of performance into account when we set our both ordinary profile and our total dividend profile. So hopefully that gives you a little more insight into that. Otherwise, feel free to ask another question on it.
And as regards to long-term planning for the dry winter risk, we're very interested. We've got our own view of how the world could shake out, or the many different ways the world could shake out. We are very focused on that as a potential outcome of the swaption renegotiations that we're working on. We are, though, very confident that coal does not need to be part of the New Zealand market beyond probably midway through next decade. There will be a requirement for gas to continue on probably at least a decade or two after that. And we're working with parties and trying to give parties confidence around investment decisions that they could potentially take as part of these swaption negotiations, which we hope to round out later this year.
Okay, thank you.
Thanks.
Thank you very much. Your next question comes from the line of Stephen Hudson from Macquarie Securities. Please go ahead.
Good morning, Neil and Mike. Just a few from me. Just on the RCP3 savings, I just wondered if there was upside to that $36 million saving that you've called out and called out previously as a result of spot interest rates. I know Vector have talked to sort of more like a 60% increase in the P-naught adjustment that the Commerce Commission has estimated for them. So I just wondered if there was upside to that number. Secondly, just going to have another crack at the dividend question. Are you sort of signalling today that the capital management program that comes to an end in FY22 will come to an end as a result of the step up in the second half dividend and your comments on, sort of increased capital deployment opportunities, I suppose? And then just thirdly, just on the Genesis swaption, I just wondered if there had been any, or if you can share with us any expense or cash cost that has arisen as a result of suspension events being called.
In terms of P3, look, there may be some upside. We're certainly not counting on it, so it's not in any of our projections or forecasts. And I guess that will come through the process. We don't control it, Stephen, and because it's a bit of an unknown, we don't count on anything more than what's been published. Similar to the actual the transmission pricing reform itself, we don't count that in any forecasts that we produce until it's actually delivered. What was the second question?
Second question was on
the dividend again.
Dividend and capital management program, and we're not. The capital management program ends at the end of December for year 21. So we're not making 22. Sorry, we're not making any statements about the capital management program here today.
No. I think what I said last year was we would give the market an update every couple of years. So once we're a couple of years out from the end of that capital management program, we'll give you some clarity as to what we expect to happen. I guess what we are signalling, though, there is potential for growth, driven by demand, driven by asset retirements, whatever. And we're just trying to make sure that we've got the balance sheet flexibility to participate properly in that growth and ultimately achieve our end outcome objective, which is maintaining our market share of generation in the New Zealand market and growing our Australian business to something that's meaningful in terms of a proportion of the overall bottom line of the company. And then the Genesis swaption in terms of cost of suspension events.
They're not material.
They're not material.
No, there's no material issue there. We've got a disagreement over the way that functions, and we'll work it through with them. We've got a good relationship with Genesis. We've obviously had a long-standing relationship with them in relation to the swaption and plenty of other transactions. So we'll just work our way through resolution of that challenge.
Great. Thanks, guys. Thank you very much. There are no further questions from the phone. Please continue, gentlemen. Thank you.
Okay, well, thank you all very much for attending. We're quite proud of the result, as we've said, but don't quite expect the same numbers next year, please. Thank you all. Cheers.